My name is Tony Downs, and I'm a senior fellow at the Brookings Institution in the Metropolitan Policy Department. And this is a session to discuss possible public policies concerning how the government should respond to the current credit crunch and financial crisis affecting the United States and the rest of the world. And it's also to discuss whether the government can respond effectively in a society that's supposed to be proud of its free enterprise traditions. Now, we are fortunate to have three former HUD assistant secretaries to present their views, and the former chief economist for Freddie Mac. So there are people who have been in the thick of the battle at some times or other, and some are still. And so we're looking forward to a good discussion among them. Now, I was originally told to allow each person 5 minutes to talk on the most important crisis we've had since the 1930s. And I realize that's a pretty stupid assignment, but nevertheless, I decided to be in a generous mode. I'm going to extend that to 7 minutes apiece. At the end of 5 minutes, I will say 5, or at the end of 6 minutes, I'll say 6 into this microphone. I do have a stopwatch. I had one when I came in here anyway. I do have a stopwatch. And so I'm going to make a brief opening statement, and now I will briefly introduce our speakers. Robert Van Order is a former chief economist on the far right, my far right, from Freddie Mac. He's now at the University of Michigan. I hope he's still there. Susan Woodward was a former assistant secretary of HUD, as was John Weicher and also Susan Wachter. And HUD has largely been a spectator in this crisis so far, with Treasury and the Federal Reserve providing the government's major policy responses. I'm sure these discussions, however, will not be limited to what HUD can and should do, but will cover what all the federal responses should be. Each participant, as I said, was originally limited to 5 minutes, but I'm going to give them 7 minutes. And the federal government has clearly decided it must play a crucial role in responding to the recent lending freeze. The idea that all remedial action should be done by the private sector is dead, as is the idea that there should be minimal government regulation of financial markets. Whoever wins the next election, may God rest him, have him peace, because he's going to have a miserable prospects in front of him, will be faced by the idea that he's going to plunge directly into the midst of having to respond in force to the current distress in the markets and the economy generally. Now, I must confess that I am almost finished writing a book for the Urban Land Institute on the current credit crunch and financial crisis. It's difficult to write because the situation keeps changing not only daily, but hourly. At the outset, I will make two substantive remarks. One came from a book I wrote last year for the Urban Land Institute entitled The Niagara of Capital, and that was about the tremendous flood of capital that flowed into real estate after the stock market crash in 2000. And right after the book that I wrote was published, the flow of capital into real estate stopped, which definitely restricted the sales of my book, I must say. The most fundamental cause of all our present financial problems, in my opinion, ironically, was a massive inflow of financial capital into the United States and other real estate markets from all over the world that occurred after the stock market crash of 2000. Amazingly enough, it was that excess of capital demanding to buy or to lend on real estate, capital that was fleeing from stocks, that generated a huge excess demand for housing and commercial properties. That demand drove prices up, drove cap rates down, and caused such intensive competition among capital suppliers that they abandoned all reasonable underwriting of their transactions in their frenzy to capture the next piece of property that they saw in front of them. So a Niagara of Capital eventually led to a desert of lending. The second substantive observation is that the financial sector of the U.S. economy, in my opinion, is inherently unstable and therefore automatically generates financial crises of differing seriousness from time to time. This theory is not just mine. It's after considering all the books that have been written on this crisis that came out before mine has, I came to the conclusion that the theory of Hyman Minsky, that prolonged prosperity causes rising optimism among lenders, property owners, and property buyers, is the most important theory. As prosperity continues, all three groups become more and more willing to use increased leverage to raise their returns on equity as they become more optimistic. So leverage increases until some unpredictable event causes a sudden downturn that makes lenders want to be paid off more quickly. That leads to a credit availability crisis that can become a downward spiral like the one we have now. The only way out of such a spiral, said Mr. Minsky, is for the federal government to reduce interest rates and flood the markets with money, as it has done. And this shows that a series of little things like increasing optimism among many millions of lenders can lead to very substantial outcomes. Which reminds me of something that happened to me when I was very young. I used to play a game called Spin the Bottle. Have any of you ever played Spin the Bottle? May I see your hands, of anyone? Well, there are a few people. Most of the people who raise their hands are older like I am, because today young people don't play Spin the Bottle, they play Spin the Bed. They don't waste any time with the Spin the Bottle. But in my day, we were more conservative, and I played Spin the Bottle a whole lot. In this game, a girl spins a Coke bottle. If it points at a boy, she either has to kiss him or pay him a nickel. And I played this game a whole lot with the amazing result that by the age of 14, I owned my own home. Now, the problem with Minsky's approach is that the only way to get out of this is have the government spend a lot of money, is that, as he said, it leads to inflation, which can in turn only be stopped by raising interest rates high enough to cause a recession, as Paul Volcker did in 1980. Another cause of instability is that random negative events outside of financial models almost always show up at regular intervals. In short, recessions seem to be inevitable, and curing each one eventually causes another one. Now, I hope that's a controversial enough view to stimulate a lot of discussion. And on that happy note, I'll turn to our first speaker, Bob Van Orhert.
Can you hear me? Yeah. Okay, I usually sound better than this, but I'm losing my voice. You're going to have to bear with me. But you can, or either that, or you can think I'm doing The Godfather. Okay, I'm going to do a little bit of background. The agency there are two senses of agency here. One is the agencies in the bond market sense of Fannie, Freddie, and Ginnie as the agencies that securitize stuff. And the other is agencies in the sense of Treasury, the Fed, and all of that. And I'll touch on both of them. What I want to do is do a little bit of past, present, and future and talk about policy. But what I also want to do is kind of single out one particular thing as central to the problem. And in this respect, I disagree with Tony about it. In looking at the past and the recent past, there are two ways, I think, of posing the problem, two things going on. One is a huge increase in defaults on almost everything, but especially subprime and to some extent Alt-A. And this comes from two things, I think. One is simply that house prices fell. Okay. The other is some underwriting and problems with underwriting. And there's some recent stuff that Dennis Capozza and I have done, particularly looking at subprime, but other things that suggest that in terms of the surge in foreclosures, you can divide it approximately 50-50. What's interesting about it is that the 50 that you can't explain with economic conditions and particular prices is very hard to explain with the usual suspects, credit scores, down payments and stuff that people knew about. Okay, it looks like a fair amount of it is moral hazard, stuff going on that investors in the securities that I'm going to get to talk about didn't understand. But I'll get to that in a minute. The second thing is a kind of contagion, a seizure in the markets, which is spreading to other parts of the financial system. And I'm going to suggest a common culprit in all of this. But a culprit in different ways, and that's subprime securitization. It's not just subprime, and it's not just securitization. Both of them have been around for a while, but the two together were a real problem. And there was a surge, a kind of regime shift, right after 2003, when the non-prime, meaning subprime plus Alt-A share, went from about 10% of originations to a third in basically less than 2 years. That was a very big deal. And the securitization of subprime went from about half to about 80%. And it's not simply that things get securitized, and it's not just it's in the details of the structures, and in particular, the way that subprime and Alt-A worked in somewhat different ways for the two of them. was securities that were structured. The technical term for that is sliced and diced. And it's not just structuring. Structuring has worked in a lot of ways in the financial markets. Setting up senior subordinated types of structures is actually not a bad way of setting things up. But these were complicated structures, and it was particularly complicated was in some of the subprime ones for, first of all, the details of how the different tranches kicked in and what the subordination was weren't transparent. But especially, what made the deals work was selling the subordinated pieces. The trick in the deals was to get as much as possible to be rated AAA, because you can sell that stuff to almost anyone, and these had somewhat higher yields. The trick was getting people to take the subordinated stuff. That stuff was hard to sell. So quite often what happened to it was resecuritized, restructured into CDOs, and collateralized debt obligations, and into structured investment vehicles. The structured investment vehicles were a little bit different. And some of these were structured again. There are two things about this that I want to point out. One is you increase the distance between the investors who are taking the risk and the mortgages, and it makes it very hard for them to really get a handle on what's going on. As long as there's inflation, it works. Right? These were very inflation-sensitive things. The second, and I think very important one from the standpoint of the immediate problem, which is the seizure in the markets, is once the stuff starts to hit the fan, the ability of these security holders to get from what they hold to the underlying mortgages and analyze them is really awful. They just don't know. And a measure of this is some different measures, and I've got three. One was the Bank of England earlier this year came out with some numbers that said subprime losses would be about 170 billion and write-downs were going to be about 400. IMF came up with higher numbers. I did an informal survey of one person whose opinion I trust, who prices these things, who also argued that the write-downs are way bigger than what the subprime losses are going to be. And I view that as a measure of the liquidity problem, that people just don't know when they're holding these what they've got, and the sum is way worse than the sum of the parts is way worse than the whole. And I think that's what's underlying, in particular, of the spread to other parts of the system, because then you don't want to lend to companies that have this stuff. You don't want to lend on this stuff as collateral. You don't want to hold commercial paper that's in structured investment vehicles that have this stuff in it, and you really don't know. So that's a sort of a background. In terms of understanding what's been going on recently, two things. One is what the Treasury was up to, at least in the initial stage, was very much, I think, directed at this second thing. The problem that there's so much of this crappy paper out there that nobody wants or understands very well, that they just wanted to get it out of the system so that people could have some confidence in the system. The other is what's happened, and this, a lot of speakers have talked about this today, is the mortgage market has moved toward the agencies, Fannie, Freddie, and Ginnie, overwhelmingly. That's the market now. One of the things that's been happening is that Fannie, Freddie, and Ginnie are the only counter-cyclical thing in the market. The rest of the market, partly from accounting rules and partly from fear and loathing, has been pro-cyclical. Okay, going forward, what's going to happen with the agencies and the policy? Well, Susan Woodward is going to talk a bit more about Fannie, Freddie, and Ginnie. So I think I won't say that except to say that I agree more or less with what she's going to say. But something needs to be done with them one way or the other. The other is that the other problem, the foreclosures, I think is essentially unsolvable. I don't think the restructuring can be done in a way that helps a lot. And that's the other problem going forward. And from this question of can the agencies do much about that, I think probably not. What they can do is provide liquidity, and that's it going forward. Done.
Susan?
Okay. Well, I was on the other side of the world when the organizing phone call for this panel took place, so I'm actually going to address the question that is in the program. What can the agencies offer, and are they up to the job going forward? I have much more to say than I'm going to say, and so I'm going to give John Quigley the written version of my talk, and he can put it up on the website for those that are interested in more of the gory details. One of the questions that is open right now is what will happen to Fannie Mae and Freddie Mac when they come out of conservatorship. They're now in conservatorship, so essentially the government is running them. And will they be reorganized, or will they re-emerge and have stockholders like they did before? I want to talk about 4 features that Fannie and Freddie have that I think really contribute a lot to the quality of the mortgage market in the United States and should be retained. The first one is they are effective at inhibiting the overproduction of information in mortgage-backed securities markets, and as a result, give us a more liquid mortgage-backed securities market and lower mortgage interest rates than we otherwise would have. It's efficient. Second, I want to talk about the flexibility of organizations that they have as a result of being private firms. And especially I want to compare them to FHA and Ginnie Mae in their capacity to reward lenders with good behavior and to discourage opportunistic lenders for their opportunistic behavior, and contrast the ways in which FHA and Ginnie Mae have a hard time doing that, and Fannie Mae and Freddie Mac are pretty effective at it. Second, I'll argue that we do need 2. We need 2 in order to have them compete with one another. There are some industrial organization economists who might argue that 2 is not enough for true competition. I think the nature of their competition is that 2 is close to perfect competition because the prices get set behind closed doors. They're only revealed in an aggregate fashion in the quarterly reports, and that essentially big lenders can go back and forth, and we get competing bids and pretty competitive prices. The fourth capacity that Fannie and Freddie have that should be retained is outstanding research shops. They both have organizations of very good people and outstanding and rich data that can answer a lot of questions. This is generally not very appreciated. It's often even not appreciated inside these organizations because there are plenty of stories about how the risk management shops were not listened to, were overridden by the business people, and as a result, a number of loans were under-reserved. Okay, first, inhibiting inefficient overproduction of information. The examples that Jack Hirschleifer gave in his famous old paper, The Private and Social Value of Information and the Reward to Inventive Activity, are still the best. The Salk vaccine versus horse racing. The private versus the social value of the Salk vaccine. The private value was vast. The private value was big, but the social value was truly vast. And so even as a monopolist selling the vaccine, getting rich, making the vaccine, the social value is still larger because the seller can't capture all the social surplus there. And so we have underinvestment in information of that type because the producer of the information can't capture all of the value. But contrast that with horse racing. Horse racing has high private value if you could figure out which horses are going to win the race, but the social value is 0 because it's purely redistributive. And so any resources spent on producing that kind of information are, from a social point of view, pure waste. Okay, now let's go to something a little closer to the securities markets. In the municipal bond market, municipal bond issuers generally do not want to have one great big long bond, 30 years, 40 years, and have a sinking fund and pay it all off at the end. They want to pay it off in bits and pieces, kind of like a mortgage. But the bond market's a rigid place, so they can't quite structure it that way. So what they do is issue a serial bond where parts of it mature year after year. Little issuers can't do that, because the little issuers would have too many little tiny pieces. They'd all be illiquid, there'd be no trading, it would be expensive. So what do they do instead? They have random calls. They say, we're going to just randomly call 2% of this issue or 3% of this issue each year. Now, suppose we sell the issue, we tell folks what's going to happen, and then we roll the dice to decide what pieces are going to be called. Should we then reveal, as soon as the issue is made, which pieces are going to be called? No, because once again, we'd just be back in the situation with a bunch of little bitty pieces, all illiquid, wide spreads, low prices, and high yields. And so Fannie and Freddie do something like this in the mortgage-backed securities market, and I think it's part of the reason why we have lower interest rates as a result. And we have, Frank, help me, Frank at Freddie Mac.
No Taft.
When Ginnie Mae was introduced, securitizing FHA mortgages for the first time, FHA interest rates fell 60 to 80 basis points. That is not a small number. It's a big number. It came purely from liquidity because the additional federal guarantee was epsilon above zero. And so without Fannie and Freddie, we would have smaller mortgage-backed securities, less liquid mortgage-backed securities, higher mortgage interest rates, and more income to investment bankers. Nobody's in favor of that now. Okay, the organization as private firms. Let me tell you a story about what happens at FHA and Ginnie Mae. Builders and lenders get together and they form charities, and they give them very appealing Old Testament names, and they donate money to them. And then these organizations make gifts of this money to prospective homeowners who buy the builders' homes. And so as a result of this movement of money into the charity and then back to the builder, FHA ends up with 102% LTV loans instead of 97%. There's not much they can do about that. But Fannie and Freddie do. Fannie and Freddie wouldn't tolerate behavior like that. They do a very effective job at curbing opportunism. So we got to keep this too. As for keeping to, I'll let you read about that because I really want to get to the bottom line of research and the role that Fannie and Freddie can play in research. Up until a couple of years ago, Fannie and Freddie did research, but whenever they started looking at questions that would benefit borrowers and maybe not lenders, like mortgage broker compensation, a few phone calls were made and that research was shut right down. The atmosphere has changed completely. Now they're in a position and have the data to do the research to help homeowners figure out what the deal is. The time has come to improve mortgage disclosures, and they could be leaders in doing the research to support improved mortgage disclosures. I mean, the Fed's interested, the FDIC's interested, HUD is interested. They've all done studies. We don't have to establish that homeowners are confused. They're very confused. The results of my own studies were disheartening. Anyway, got to keep them. They know a lot.
I'm sorry to have to cut you off, Susan, but okay, John, you're up.
Okay, thank you, Tony. When John Quigley had his opening remarks, he talked about all the agencies that we had people here from, and he finished up and he said, and we have people from HUD and FHA. John, FHA has been part of HUD since HUD was created in 1965, and it still is, and I'll come back to that. As the Hope for Homeowners program began to get talked about this summer, I got a lot of calls from the media along the lines of, can FHA possibly handle this kind of expansion of business? I was reminded that when I first came to HUD in 1973, the first of several stints, one of the first things I heard was that FHA was on its last legs because the private mortgage insurers were busy taking all the market and would put them out of business. At that point, FHA had been in business for 39 years and had insured 15 million mortgages total. Now FHA has been in business for 74 years and it has insured 40 million home mortgages total. And the private mortgage insurers seem to be on their last legs. I think there's more recent evidence that FHA can certainly handle an expansion business. When I was commissioner in the year 2003, we had a huge expansion of our business from unexpectedly from 2002 to what became the second biggest year in FHA's history. It may get topped in the near future, but it was the second biggest and remains that. And we had no trouble at all handling the business. The process of originating, of approving FHA mortgages has been simplified a lot in recent years. My two immediate predecessors, Bill Apgar and Nick Retsinas, simplified the arrangements. It used to be that you got FHA loans approved in any one of 75 field offices, in whatever one you were in, and it was approved by FHA HUD employees. What that meant is if there's a big boom in, say, Seattle, there's a long line to get approved because there are no more staff in Seattle. You can't move staff unless staff is willing to be moved except under extraordinary circumstances. Conversely, let there be a drop-off in business in Texas, as in the early mid-'80s, and you have staff sitting there twiddling their thumbs. What's happened is that was consolidated into 4 offices. And most of the post-approval, the approval work is done by contractors who can add staff and lay off staff effectively at will. Their job is simply to make sure that the documentation is right, that the same dollar amount for the loan appears in all the relevant places, that the information is there. That works quite well, enables FHA to originate whatever volume of, to approve whatever volume of loans is originated and offered to it and meets the standards. And actually, since 2003, FHA has improved on that. We added our own version of a automated underwriting system. But the complication comes in, the problem comes in that how you manage the quality control. FHA now handles that in two ways. One is a post-endorsement review. I think it's 10% of loans now, which would, part of them are chosen randomly to be reviewed by FHA staff and to see if they are, in fact, good-looking loans. And the other method, and this is more important, is through a process called Credit Watch. FHA knows, and we saw some of this from John Craner's slide in a different context, FHA knows that if a loan is bad in the sense that it shouldn't have been underwritten, it is likely to go bad in the first year or two, whereas normal FHA loans tend to have a peak in their defaults in the third, fourth, fifth years. You can see a difference there. FHA monitors lenders in terms of the early default performance of their loans and has the ability to throw them out of the program if they're doing badly. That works well if your lender is interested in continuing to do business with FHA. Where it may not work well is with Hope for Homeowners, where you are a lender on your last legs and you want to dump the damn portfolio on somebody and you don't care what happens to it afterwards. You're not interested really in doing business with FHA down the road. There's been some discussion in the trade press that FHA wants more staff to handle Hope for Homeowners, and I don't know anything about what Commissioner Montgomery has in mind, but my guess is that what's needed is staff on the post-endorsement review process and the credit watch process, quality control. But there is no capacity constraint for doing any volume of business, and FHA's capital position is quite good. The requirement is for a 2% capital ratio, statutory. FHA's current capital ratio is about 6%. In fact, I had to spend quite a bit of time fending off members of Congress who wanted to take FHA's reserves and use them for the National Affordable Housing Trust. That got discouraged by Hurricane Katrina and still further discouraged by what's happened in the last year. But FHA's capital position has dropped only slightly as of last year. The actuarial review for 2008, which is the fiscal year 2008, will not become available until later this year, and I don't know what that is going to show. But last year, which wasn't a great year, it basically held just slightly below, a few basis points below where it had been the year before. Now, the economic value of FHA depends to a large extent on projections. The calculated economic value of FHA depends to a large extent on projections of house prices, and so that may show a deterioration in the expected performance of the current books of business.
That's 6 minutes, John.
Thank you. FHA works as well as it does partly because of the Credit Reform Act of 1990, which says if you are a federal government credit program and you have losses, you need an appropriation for the losses. Nobody wants that. FHA has avoided that effectively. And the other factor that counts is competition. FHA has to compete with private entities for business, and that is a good discipline. The Act this summer raised FHA's mortgage limits to the GSE level so that it's now in a position to make loans well up in the income distribution. It's basically in good shape. Coming back to whether to HUD and FHA, should FHA be in HUD? Well, there's certainly complications to being in HUD. I ran into more than a few, and I think every other commissioner has as well. But FHA carries the full faith and credit of the government of the United States. Do you as a taxpayer want some private entity playing around with the full faith and credit of the government of the United States? Or would you want your members of Congress, whatever you think of them, your senators, whatever you think of the president, would you want somebody riding herd on that? To my mind, the answer is yes. Otherwise, you have a GSE, and despite Susan and Bob, I think that's not a good model.
Last but not least, Susan Wachter.
Thank you. I have a PowerPoint. I hope this can hear me okay. The question that I'm going to address as we look at understanding the sources are, given the circumstances of the crisis that we are all in, what can we do going forward? And in short, this is a made in the USA problem. Trouble in the housing market, 2007 March, rough out there, and now we have a maelstrom of destruction made in the USA. Now, you all know this graph, particularly Chip Case knows this graph, since it's Case-Shiller data. And of course, housing prices took off, increased their acceleration, and peaked second half of 2006 and are rapidly declining. What is less well known is through 2003, we were right in the middle of the pack of peer countries. Now, these are not exactly peer countries. This is work with Andrei Pavlov and Jesse Abraham, and I can be glad to give you the source and other charts, which because this is corrected for volatility. But we are in the middle of a pack of our industrial peers, except starting in 2000, and we were very low volatile compared to our peers. That's why we appear to be on the top. But even with this, you can see 2003, we depart dramatically and then fall dramatically. What happened in 2003? Well, as you can see, for household debt took off in 2003. Financial debt took off even more in starting in 2003. And so did aggressive non-traditional mortgages. This is starting in December '01. The blue is interest only. The dark blue is the top line is non-prime overall. And as you can see, not only did non-prime accelerate starting in December 2003, but interest only accelerated, and so did pay option, which didn't exist before. These are incredibly dangerous instruments. What was the impact of all of this increase in liquidity? The increase in liquidity and quote-unquote affordable products was to increase the ability to demand, particularly in high-priced markets like California, and increase in housing prices. Now, it is true that bad loans show up in defaults, but bad loans do not show up in defaults as long as housing prices are rising. And here we have a case of bad loans creating higher house prices and therefore uncovering the problem. Now, mortgage originations over time, FHA, VA dropped considerably, halved in this period. Conventional conforming dropped. Jumbo dropped. What increased was subprime, Alt-A from 2% to 11%, and HELOCs. And also what happened in this period within each kind of loan type, I have two charts, I'll go with this one. You'll be able to read it more carefully. I understand you can't see this, but you will be able to look at it when these slides are made available on the web. But in particular, what's interesting here, of course, is that within each loan type, we had a movement up in terms of consolidated loan to value. So for example, in subprime, consolidated loan to value went from 45 or so to 64. Alt-A from 20 to 55. And that's on average, not the margin. Seconds, which were only 3% of subprime, became almost a third of subprimes. Low docs, which were almost all loans were full docs to begin with, more than half became low docs, et cetera, et cetera. So within each type, we overlaid the risk. Now, what's interesting as the systemic risk grows, what happens to the premium? What happens to the risk premium, the WACC or the spread to WACC? It declines. So investors are not seeing the systemic risk. They're not pricing the systemic risk. As these subprime loans are made, so do house prices go up, and here's where they're declining, the same places. How did we get here? Well, we all know that how we got here. What we don't perhaps quite yet understand is the microstructure and the incentive misalignment and how to undo that. for the long run? Well, borrowers, of course, were not expected to repay. They were given teaser rates. Originators were originating to distribute. They didn't own the risk. The secondary market making tremendous fees in bundling. The regulators, most importantly rating agencies, were in fact given AAA ratings. And then there are the investors. Great puzzle. You know, I understood all of this, but I didn't understand the investor part as this was going on, because no one believes, you know, we know that the AAA ratings are, you take it with a grain of salt. So what about the investors who were, in fact, buying this? Well, I didn't understand it until the actual end, when we had the Aig Rescue. As it turned out, the Aig Rescue, AIG was, until recently, a AAA entity. AAA entities were allowed to provide credit default swaps. So as an entity which was getting fees from these mortgages, holding these mortgages, you could also purchase a credit default swap from a large entity which was by law not required to regulate, and the states could not regulate to reserve. So as of 2000, AIG and other AAA states were preempted from requiring reserves against these CDS. And one could argue that the CDS might be thought of, it's issued from these large agencies as being too big to fail, and in fact they were. But it can't be just that. Too big to fail is part of it, and the expectation, because there is counterparty risk here, so you could worry about the counterparty risk with AIG, but it's too big to fail. Markets, as a finance professor, I believe markets work not all the time. They don't have to work all the time, but over the long run, because you have sellers and buyers. These CDS were marked to model, not marked to market. Therefore, they did not trade. So we had the optimists pushing up the price and no short sells. Fannie and Freddie, their role, as you can see, up to 2005, they were pushed out of the market with the growth in fees of other entities. Fannie Freddie also didn't grow until afterwards, and then they did. They participated in the erosion of credit standards, which increased prices. We have the adverse feedback loop, foreclosure waves, and going forward, we are going to need regulation. Thank you.
Well, now we have a chance for some discussion among the people who presented, and I would like to ask the first question of Susan Woodward. She's the first person that I've heard who defended lack of transparency and said that lack of transparency was a good thing, whereas most people have been saying lack of transparency was one of the causes of this problem. Would you care to explain that to me, Susan?
Well, I think the best example, again, at an intuitive level, is the municipal bond issue that's small, where the issuer really needs a serial feature to retire the bond, but the issuer is too small to issue a true serial bond. And so by issuing a bond that has a random amount called each year, so nobody knows quite who's holding the pieces that are going to be called, there's a single issue, it's more liquid, the spreads are tighter, and the issuer gets a better interest rate for it. And so deciding when to reveal more information or reveal less information is, it's a hard question. It's not an easy question. But if we look at what happened in the subprime market and the number of pieces the securities were chopped into and how illiquid they are, it seems that Wall Street's incentives to provide liquidity and make tradable pieces is not very strong. I mean, a similar phenomenon is seen in the Treasury market. I mean, Wall Street is always down at Treasury lobbying for more different Treasury issues. When Treasury proposes, oh, well, let's just open some existing issues and sell some more bonds in an existing issue, they say, oh, that's a terrible idea. And the reason they think it's a terrible idea is because it doesn't create another clientele for whom they can do some custom pricing. So there's always sort of a little tussle going on between Treasury and Wall Street over what Treasury ought to be selling, where Wall Street is lobbying for more issues and Treasury defending the taxpayers for fewer.
Now, Bob, you said that you thought lack of transparency was a bad factor in part of the contagion of markets and the problem of spreading.
Did you do a double negative there?
Pardon?
What did you say? That lack of transparency?
I thought you said lack of transparency was not good in the general market, where you said that the distance between the borrowers and the lenders.
Oh, the lack of transparency was a problem. Yeah, but there's transparency and then there's transparency. I think in the security structures it's a real problem.
That's not very clear.
Yeah. Well, I'm not trying to be excessively transparent here. But there was too much transparency in a large part of the market because, remember, the rating agencies, one of the things that happens is you've got originators and investment banks who are trying to get the biggest share of the deal, get a AAA rating. And they know what the stress test and what the criteria are from the rating agencies and from the investors. They're rather mechanical things like stress tests. And once you know that and it's excessively transparent, then what you do is you deliver the worst crap you can subject to passing the test. It's a standard cheapest to delivery thing. So there are places where you want a little lack of transparency, but certainly in the securities, the distance between what the security holder had and what the mortgages were doing was a major problem, and I think it's still a major problem in what's going on with the securities and the contagion.
Now, you also said that you thought the foreclosure problem was insoluble, so you were rather skeptical about all of the suggestions that were made in the previous panel.
I'm not suggesting not trying, but what's happening is house prices, the sort of the brute fact is house prices have dropped or will drop on the order of 20% from the peak, and it'll be worse than that in California. And once that happens, there's stuff you can do to make life easier for people, and you should. But that's a hard one to avoid. You can forbear. We worked on that at Freddie. I remember someone coming in from the field and saying, we should forbear on some of these loans because we think property values are going up and they'll be able to make the payments. My reaction was, well, gee, the property values are going up, you should take the property. There's a trade-off here. But there's also a trade-off, which is property values are low and are falling. And the question is, to what extent are you postponing what's going to happen? Would it not be better to get it over quick? I don't know the answer, but I think in places like California, there's not a whole lot that's going to be done.
Well, I have a question about the whole concept of housing prices. It seems to me that when we hear in the California Association of Realtors in its September report said that housing prices, the median price of units sold in California in August 2008 was 40% below the median price of units sold in August 2007. But the main reason for that drop was a tremendous change in the composition of what was selling. In 2007, 21% of the units, as I recall, had been foreclosed units. In 2008, 72% had been foreclosed units. So we don't make any distinction between unforeclosed units, the housing that most of you in this room or your parents live in, that is not distressed financially, it's in a nice neighborhood. That housing price has probably not fallen anything like 40%. But we mix in foreclosed units, which are all sold at a discount of 25 to 30%, with those that aren't foreclosed. And so when we get a single number from either if it's Case-Shiller or National Association of Realtors or OFAO, we get a number which is very difficult to distinguish what kind of prices we're talking about. And to what extent do you think that people's feeling that the price level of housing as a single idea has fallen 25% is really true of all the housing in the United States? Do you think that's true, and what difference does it make?
It's not true.
Yeah, can I say?
I agree it's not true.
There are two dimensions there. One is the composition, which indexes like Case-Shiller take care of because they use repeat sales. But the other is
no, but that doesn't take care of it because
it takes care of a lot. But there's the issue of it being dominated by foreclosures, and is that distorting it? And it probably is. The OFAO type index is less distorted. It's gone down by less, but it's still going down pretty sharply as well.
You really can explain the difference across cities by looking at the foreclosure sales. They really explain a lot. But they're part of the market. Those are properties which did change hands in an arm's length sale. So leaving them out, I mean, certainly doing aggregate index is always high.
I don't think you should leave them out. I think you should distinguish between the two different types of housing. and that price index which distinguishes between them would give very different signals to people who own houses who are thinking about whether they should stop making their payments or not.
Yeah. The whole logic of repeat sale is that it's a similar house, but if it's been trashed before a foreclosure sale, it's not a similar house. So this is a real measurement issue. It's not enough to say it's just part of the market. It's an altered house. And there is another way to take account of this, which is to include a foreclosure effect, a time-dependent foreclosure effect in your equation, which you should do. But it's going to change the index a lot. And so I'm surprised that you don't do it. You do? But you don't publish it.
We don't give it away quick.
Well, you're prejudicing many people who may think that their housing has fallen in value when it really hasn't. That's what worries me.
I agree with that, and I say that a lot.
You say it, but you hide the numbers, though. Well, you just said you wouldn't give it out unless they paid for it.
The full correction takes a anyway. I have to wait until my partner to defend that tomorrow.
I'm going to let the audience ask questions. If someone wants to ask questions from the audience, maybe there's somebody's asking a question.
So for any of the panelists who would like to do it, one of the sort of controversial issues in the predatory lending bills in Congress of recent consideration has been the idea of assignee liability. That is, having investors bear some ongoing liability for the origination problems in the loans. Right now, borrowers have no place to go. The liability essentially evaporates once these loans are securitized, even as a defense to foreclosure. And I'm sort of wondering what your views are about the necessity and the prospects of having some kind of a liability to ensure that to sort of fix some of the incentive problems in the originate to distribute model going forward.
Anybody want to answer that? Apparently not.
Making the originator of the loan bear some of the risk would clearly inhibit the lender from making more bad loans. But an equally important part of this is to make sure that the borrowers understand what they're signing up for. I've attended enough focus groups and read enough of the studies and done some of them myself that I'm very convinced that the borrowers do not understand what they're signing up for in many cases. Even in studies where I have 7,000 30-year fixed-rate loans, the simplest terms out there, when I look at what the people pay who live in census tracts where pretty much all adults have a college education versus those in which none do. The people in the less well-educated census tracts, pay an extra $1,200 in closing costs on their loans. And it's because they don't understand what the deal is and they don't understand how to shop. And so we need a big effort on research to improve disclosures in the mortgage market.
Tony's.
So is that a no about assigning liability? Disclosure alone will be sufficient? A perfect disclosure regime will address that downstream?
I believe of the two, improved disclosure will help more than making the lender keep a piece of the loan. Because the subprime market's going to mostly dry up anyway. And in the prime market, it hasn't been a huge problem. Lots of lenders have sold their entire portfolios of prime loans to Fannie and Freddie. They've been securitized and they performed fine.
John?
A couple things. One is, One is that we have a repeat sales phenomenon here as well as in price indexes, which is that there are people who do bear the responsibility, do bear the costs, do business with the people who impose the costs on them on a repeat basis. Consumers typically do not. Lenders do business with mortgage brokers on a repeat basis, and if they get a lot of bad loans from mortgage brokers, they can stop doing business with those mortgage brokers, and to some extent they do. The same thing applies, I think, with securitizers. I'm not sure that a legal arrangement here, I'm not sure the government is going to be able to do it better, but maybe they can. I'd like to go on with something Susan said, and this is, Tony gave the Susan who was just talking. Tony gave us this list of 13 questions to begin with, which most of us have ignored. But one question was not in his list, and that was what could we do to get consumers more involved in the process. And here we need more disclosure. We need much more transparency. I don't know what Bob's talking about, but we need real transparency. They need to know what terms they're getting and what the loan is, and what the downside is. Susan and I have devoted time to trying to reform the Real Estate Settlement Procedures Act within the law, reform the regulations. And I've tried to do it twice and have the scars to bear it. The administration is now trying to reform the disclosures under RESPA, has a proposed rule. They are probably going to put out a final rule. I don't know this, but they have so far apparently refused to give in to industry pressure. And there's been an enormous amount of industry pressure to try to not provide better disclosures under the current, current proposals. Consumers have more skin in the game than anybody else. And the more information they have about what they're getting into, the better off they will be. And that hasn't really seemed to be on anybody's agenda except maybe Susan's and mine.
Yeah, I mean, the big silver lining on these terrible clouds of the mortgage crisis and the credit seizure is that it's an opportunity for research-informed disclosures like we haven't ever had before, except maybe in 1933, which was before I was born. So it's an opportunity to overwhelm the political pressure from lenders who don't want better disclosures, except maybe a little bit to protect them from being sued. They finally at least approached Fannie Mae and said, you know, can you help us, you know,
Susan Wachter.
Create a disclosure to defend us. But we can't waste the opportunity. It's not going to come again for a long time.
This is the first panel that I have been on where there have been such uniformity on this issue, having spent my years at HUD pushing for RESPA reform and also putting out a report with Treasury on the dangers of predatory lending and the lack of information that borrowers have. I cannot agree more. But I also agree with Paul Leonard that assignee liability is critical. And my understanding is that the current new rules, regulations that the Fed have put out, but Paul, maybe you can tell me about the details here, because the details matter, if there is a liability to the securitizers if they are securitizing other than the default mortgage, the standard default mortgage. Is that not true? It was in the original proposals, I believe.
Under HOPA.
Under HOPA, yeah. Right.
Go ahead. Speak.
Let me defend our indexes a little bit for a moment. A couple of things. First of all, if you look at the 20 cities, and half of them are down only about 10% or less. So it's not everywhere that this big infection is taking place. And the infection, if you look at Florida, Arizona, California, Nevada, and a handful of others are down, 30, 35, 40%. Now, most of that is give back of a bubble in the lower tier. The lower tier is out there. Those are free, right? For all the cities, you can get this high, middle, and lower tier. And the lower tier was a run-up in land value that went away. And I don't think you can. I can't tell you how much is due to deterioration of the capital, but I don't think it's a lot. If you look at the lower tier across these cities in the latter part of this decade, the lower tier tripled as credit came into that part of the market since 2000. It tripled, and when it triples and you're dealing with the low end of the distribution, you're giving that back. So I don't think we're.
Tell us what the value of the dummy on foreclosure is.
Yeah.
Bob's in charge of that.
Yeah, Bob's in charge of that.
That was not a question, but I will answer it anyway, which is that how were people affording these mortgages where the land value went up so very much if it wasn't lending standards eroding to some degree?
I'd just like to ask a couple of questions about this institutional reform issue. From what we've seen in the FHA, its business went from sort of 8% to 0 in about 6 years. And until this first quarter of this year, it was essentially going out of business. And I guess the question is, to what extent does that arise from the inability of the institution to innovate and the inability of the institution to be competitive because of the way it's structured in the public sector, and to what extent does it arise from other things? So that's one question, is the sort of the placement of FHA and what you can expect out of it. The second is completely unrelated, but it's also the institutional reform of Fannie and Freddie. If you're thinking about some other kind of agency, is there any reason why you'd want an agency performing the functions that Fannie and Freddie do to have any retained portfolio at all?
Let me take on the first part of that question quickly. Okay. Sorry, John. Because I'm very interested, of course, in John's response, but no doubt about it, the subprime portion, teaser rate ARMs, were more affordable than FHA in a number of parts of the market. And secondly, FHA couldn't even operate in those parts of the market because of their loan limit.
Yeah, that's part of an answer. The FHA innovates more slowly. There are statutory limits on the kind of mortgages you could originate, and getting into hybrid ARMs required 2 pieces of legislation, because by the time the first one was passed, the market had moved somewhere else. That's not helpful. The other side of that is you avoid going after the latest fad and blowing a wad of the taxpayers' money. In addition, I think there was a study done by the mortgage bankers which came out in 2006, asking a number of their members, you're doing less business with FHA, why? And a lot of them said, well, subprimes are so much easier. And not only easier for us, but easier for the borrower, and they don't want to go through all of this, and so they're happy, and that's fine. Okay, fast forward 2 years, and it turns out that the paperwork has some value in making sure that people are reasonably good bets, despite the fact that they're a risk element, that they're riskier than probably most of us in this room.
Gentleman in the back, I'll get you.
Thanks so much. I'm wondering if we could actually go back to the consumer protection issue, which was on the table just a second ago. In this month's Harper's, in their all-star panel on the left on how to save capitalism, one of the ideas that's proposed is some sort of financial product safety commission so that we regulate credit products, et cetera, at the same degree that we regulate toasters. And I'm wondering whether the panel could comment on whether you think that that would be some sort of effective means of preventing some of these problems.
Anybody on the panel want to speak?
Just a little bit. I sort of agree, but you know, a lot of the stuff that you saw with subprime, like the 228s and 337s, weren't obviously bad bets. If you think of why would someone take out a mortgage where the rate's fixed for 2 years or 3 years and then it can go up? Well, maybe it's because you don't want to stay in the house too long. Maybe it's because you think if you make the payments, your credit score will go up and you can refinance. I understand the problem, and I certainly agree with Susan that lots of borrowers didn't know what they were doing. But you also want to be a little bit careful. The question is about matching the borrowers with what's in their interest, and that's a tough one. I think it's disclosure, and I like the idea of having sort of standard mortgages. And if you want to go outside that, you can, but you give a notification or something. Go ahead, yes, sir.
FHA loans have gone from single-digit percentages of the market to as high as 30% today, and really adopting roughly 30% of the riskiest loans, no FICO floors, 97% LTVs. Do you see any risk to the taxpayer on this new volume of portfolio that's being created for FHA? And then secondly, John, you mentioned that you did not support Susan's vision of Fannie and Freddie's replacement. What do you envision?
I think, first of all, I think FHA can clearly handle an expanded volume of business on the front end, and they're going to need more resources to manage the post-endorsement review process. That would be my judgment, and I certainly don't speak for FHA at all on this. I think that one thing that's a useful point to make, the down payment assistance programs that Susan described as FHA's problem were prohibited in the 2008 Act. They're no longer legal. which it, no, I didn't get a thing done on it. Somebody did it, and unfortunately, it hasn't happened, but immediately after, there's a legislative proposal to repeal that provision, sponsored by the entire Congressional Black Caucus, who apparently take the view that they would rather have their constituents buying homes on these terms than not being able to buy homes on these terms. But it didn't go through, and I don't think it's likely to go through in the special session. And that program, had it continued, the estimate was that it was adding about 300-400. Well, in the course of 5 years, it was going to knock a percentage point off of FHA's capital ratio. So.
Oh, well, we didn't answer the question of what form should the GSEs take now that should the federal government maintain ownership of them? Should they have a private board of directors? Should they become split up in a lot of different corporations? And then privatized? What does the panel think should be done with the GSEs?
I don't think they should go on in their present form. It seemed to me it's been clear for a long time that the profits are in the retained portfolio and the risk is in the retained portfolio, and that I think there is no reason for that to continue in that way. Whether in terms of how securitization would work, I think that's an empirical question, and I think if they can do that better than anybody else, that's fine. I think the idea of having the government standing behind them is dangerous for reasons I described. Do you really want private entities playing with the full faith and credit of the government of the United States?
Would the private entities, if they continue to be securitizing, would they follow my suggestion, and not just mine, that they still have to hold a certain proportion of what they securitized as sort of a guarantee that they...
Do you want them to hold it, or do you want the originating lender to hold it?
Well, I don't know. You tell me. I'm just a moderator. You're the expert.
I also cannot defend the big retained portfolios, and Freddie Mac operated quite effectively between 1970 and 1989 with a basically de minimis portfolio. You'll see your mere $25, $50 billion. Sort of just cash, park it, move it, and did so very effectively. I mean, that's the part that we really need to keep.
Let me put a little about this. The portfolio is an issue, but it's not the issue now. It has nothing to do with credit risk. Right? The credit risk is exactly the same whether stuff is debt funded or securitized. It's a question of interest rate risk, and that's an issue. But it hasn't been the issue over the last few years, and the portfolios have actually been frozen for a few years. So it is an issue. It's an issue of interest rate risk, but nothing that happened in terms of credit risk had anything to do with whether stuff was on or off balance sheet. That's an accounting distinction, not an economic one.
The gentleman on the back.
Interest rate risk was what put Fannie underwater in the early 80s.
Yes.
But interest rate risk, I said it's an issue, but it hasn't been an issue and it's measurable. You can measure interest rate risk.
All right, Susan, you want to say something?
Yeah, so I agree that interest rate risk is not obviously a problem this time, but certainly credit erosion was a problem this time. So while I agree that the portfolio is off the table, I don't see that going forward. The question of what form Fannie and Freddie take if they are securitizers, government-backed, implicit, explicit, but the end of it has to be that whoever is securitizing mortgages, whether it's the private sector or the public sector, in my belief, has to be regulated so that these securities are liquid and trade, so that they are bought and sold.
The back there, yes.
I just have a question of what is it that you guys are doing to help borrowers and, borrowers that are trying to get out of some of these loans, that are basically trying to sell their properties as short sales, and they're going through the process of having the banks taking 6 months to approve a short sale, where then they've also missed the best market, they've lost buyers, and their property then depreciates and then possibly goes into foreclosure, which then hurts the neighborhood. But they've done the attempt because they realize that they can't afford the property and they're trying to sell it.
Any thoughts on that? What do you mean by a short sale in this case?
Okay, in other words, they've gone to you and they've tried to work something out with the banks, and the banks have said, if you look at their issues, they say, we can help you to try to refinance your house. And they realize that even if they get it refinanced, it's not right now something that they need to do. So they decide to put it on the open market and sell it. So, but the price of the value of the house is less than what they is more than what they owe. So if they have a $100,000 loan and the house is only worth $50,000, then the bank is short the $50,000. So they're doing what they call short sale loans, similar to what they're doing with the modification loans. But they're saying we can't no longer afford it. But it takes almost 3 to 6 months to get these through the process of the bank. The bank then. The property loses value. By that time, the seller has moved out because they're trying to sell the house, and they can't, and they get foreclosed on, which then also causes another issue because then that property is worth less than it would have been in the beginning if they would have been able to sell it on the short sale. But banks are encouraging this, but they take forever to approve them.
The gentleman from Wells Fargo like to answer that question? No, he would not like to answer that question.
Let me. He had his. You want? Yeah, you will.
At risk of personal risk, yeah. Could I phone a friend? The fact is, it's a very complicated process, the short sale process, because it's not the servicer that's making the decision on the short sale. It is the investor that is making the decision on the short sale, whether it's better to modify the loan, try to retain the customer in it, foreclose on the property, or allow for a short sale. And we would agree as a servicer that it's an extraordinarily complex process and would look for solutions to find better ways to communicate between the borrower who is selling the property and the investor themselves. I think Wells Fargo does it better than any, but it still takes us longer than we would like to see to get a short sale accomplished.
But at this time, you guys have been doing this now for almost 2 years. Why is that process so long still? You guys have not only lost money, it's diminishing neighborhoods, and then when you go ahead and do the foreclosure process, the house has been dropped another 30%.
So let me make clear first that Wells is faster than any other lender, and so don't you guys me too much. Secondly, it is an institutional issue rather than an individual company issue. It's really an issue of the investment community, the servicers, and the sellers, and finding a way to bring them all together is a difficult challenge.
There's a question here.
Everybody, or a number of the panels, said that one of the issues was more information for the potential home buyer. But I'm not sure if the home buyer is going to take all the loss if they went into a home with nothing down. The people who are going to take the loss are the lenders. And they didn't, as one of the speakers said, they didn't know what they were doing. And that's what's so bewildering. And maybe it's just every 20 years, people think that everything never goes down.
Well, that means that the person who's buying the house ought to have some skin in the game, as John said. There ought to be a down payment requirement, a minimum down payment requirement, and that's why they passed that law that said you couldn't make a gift of the down payment to the buyers. And if the borrower and the person who's buying the house, that is, has a down payment of, say, at least 10%, then they've got some skin in the game. And then,
yeah, but lenders were willing to make loans with nothing down.
well, they shouldn't be allowed to do things that were stupid that wound up costing the society what it's been costing us.
Angela Mozilla, for a number of years, talked about the virtues of zero down payment loans, but the hidden subtext there was he was doing a lot of FHA business, which meant that the loss fell on the taxpayer. I didn't hear any of my colleagues say that we should have zero down payment loans. The same law which eliminated the seller finance down payment. If your parents give you money for your down payment, that's still perfectly acceptable. But the law that eliminated the seller finance down payment also raised the minimum FHA down payment from 3% to 3.5%, And that may not sound like a lot, but it's useful.
Susan.
Most of these loans were not zero down payment. They were high loan to value, but not zero. The problem is they were zero after the fact when the bubble was out of the market.
Question back there.
Couple of things. The first on the house price issue, I think it's not completely clear that treating foreclosures or sales that are basically sales with very short marketing times and throwing those out is exactly the right idea. Studies that I did in Boston in the early 1990s, and Chip knows this very well, you'd see 2/3 of the houses that come on the market exit without sale sometimes years later. So looking at house prices where there are a very, very small number of houses that transact at prices that are well above market, so to speak, because they're taking years to sell, are not necessarily either the right measure to use for house prices. So I think just sort of looking at house price indexes like that, there has to be some control for what's actually going on in the market. It is true that foreclosures have this problem of unobservably bad quality. People trash the houses, but that's not true of all of these foreclosures by any means.
Well, my suggestion was that not that this information not be reported, but there be distinction between different types of sales.
I'm not an investor in Case-Shiller or Weiss or S&P, so I'm fine with disclosing it, but I don't think many people have sort of said throw out those indexes because they enclose.
No, I didn't say throw. Now, there are other criticisms of your index that one could make, such that there are only 20 metropolitan areas and that they're mostly areas that were very high price increases in the beginning.
But
oh, S&P. Well, this is not your problem. Are you finished asking the question?
The second question / comment is I do feel like this is a little bit of a surreal conversation, as if somehow all these government entities have just been great in dealing with all these problems. The U.S. government is conservator of Fannie Mae and Freddie Mac because they actually failed. Whether or not people want to argue that, they're basically nearly gone. And the FHA has had historically a terrible record at underwriting and getting taken advantage of for loans, which, again, one can go back sort of past this cycle when they kind of got out of the business. But looking before that, the FHA did not have some incredibly great track record. So I sort of feel as if
John ought to have a chance to defend himself.
Well, but I do think that when we look at Fannie and Freddie, they're more than just this issue about whether the retained portfolios got them in trouble. The whole structure of how we do this really has to get looked at, and I know different people on the panel have different views on that. But I think this idea that they've kind of run this industry so well is really not a.
So what's your view? If you don't like what we've been saying, what are you going to say?
I think for starters, we ought to we need a process that moves them off the government's balance sheet in a significant way, and we can't have a private company.
Thanks, Tony. Freddie can speak for itself. FHA has been, in fact, covering its losses and building up the reserves since 1990, steadily. There were problems with with the loans originated in the 1980s, and that led to the first the FHA reform bill in 1990. But FHA never has required funds from the General Treasury to cover its losses. FHA can be abused. In the mid-1960s, it was being used to try to provide cheap mortgages in a number of neighborhoods in metropolitan areas, and there are some neighborhoods which are still feeling the consequences of that. And like any government program, there's always the chance that somebody's going to make you do something that is not in your own interest. But it has, in fact, enabled an awful lot of people to buy homes sooner than they otherwise would have done, and has enabled them to, most of them, a very high percentage of them have stayed in those homes until they either sold them or prepaid the mortgage and financed into something else.
Susan wants to say something.
Chris, you're absolutely right. In 2006, Fannie and Freddie were part of the problem. There, in 2005, 2006, there was model slippage. The underwriting models that they had originally held by and were working slipped. They delegated, they decided, and some of this has been documented recently, and some of it the GAO is investigating right now. We'll know a lot more. But they wanted market share. They didn't want to be crowded out the way FHA was being crowded out.
Yes, sir.
I'd like to come back to disclosure. Just a couple of factoids. Joel Slemrod showed about 10 years ago one of my favorite statistics, which is about 50% of people who fill out the 1040EZ form go to a tax preparer to do it for them. That's the postcard tax form. If you look at the marketing literature, about 35% of consumers, when making credit choices, focus on one thing, which is what is the first monthly payment going to be? That's it. And then finally, I have to note, Susan was at this conference with me, and I'm sure some others were. There was a conference at Harvard Business School last year where people were asked, so this was a group of Harvard and Princeton and Stanford professors, okay, tell us about the terms of your mortgage. What's the index that's used? What's the margin? What's the reset going to be next time? And other than one person, basically nobody could describe their mortgage accurately. And the one person who said he could was someone we all knew who could never admit that he didn't know something. But the point of all this is, we can talk about disclosure. How do you actually do it in such a way that consumers can understand what they're getting? And is the alternative perhaps that we have to limit the number of products that are available to consumers, which is an idea that kind of gives me the heebie-jeebies, but nevertheless.
But you cannot rule it out. There was another excellent conference at the end of May at the Federal Trade Commission that was entirely focused on the issue of disclosure. And one of the strong themes that came out of that conference is that the people who write disclosures should not just be lawyers. They shouldn't even be just lawyers and economists, but you have to get social psychologists involved in the process too. And the model that I hold in very high regard is the FDA's nutrition label. I mean, that was a deeply and heavily researched label, and it was also heavily fought. The food industry hated it. U.S. Department of Agriculture had their alternative label, and the decision of whether to take the FDA's label or the USDA label went all the way to the president, which is completely ridiculous. But it goes to show, what the stakes are, and what kind of hurdles we're up against. And mortgages are just the start of it. By making bad decisions.
John.
Right. Right.
John
I mean, the 1940 Act is a pretty good model because it limits how mutual funds can be compensated. They can only be compensated one way, essentially on an ongoing basis, and that is as a fraction of net assets.
John
period.
Quigley.
But there's all this literature coming out of the behavioral economics crowd that suggests that...
We got a microphone for you? Where's our microphone?
Went to the beach.
There's all this literature coming out of the behavioral economics crowd that suggests that the ways in which things are framed and the kinds of choices that are available and what is the default really matters. And so if you take this into account in the design of these mortgage terms, it certainly suggests that there's less than an infinite variety might be better for everybody. And so the question is, what's that number that's less than anything that's possible, and how does it get presented? And these are questions that are at least amenable to scientific research, and that you could imagine, even imagine a program that would try to find out what the set of terms, what the universe of terms ought to be, subject to certain kinds of constraints. That's an uncomfortable thing for a conclusion for an economist to come to, but that seems to be the result of other research by other economists.
Right, and one of the interesting findings in the closing cost studies is that there was an interesting subset of borrowers who chose to shop for a no-cost loan. Now, this is a misnomer, of course, because it just means your closing costs are rolled into the interest rate. In both of the sets of data I looked at, both were big, one 3,000 loans, the other 7,500 loans. The no-cost borrowers saved about $1,200, all things in, compared to the other borrowers. A more important finding is that among the no-cost loans, there were no race effects and no education effects. And so the market was just operating in a more competitive way when the borrowers chose to shop on simpler terms.
Yes, sir.
I just want to put in an additional plug about that while better disclosure is obviously necessary, I don't think it's going to be sufficient to deal with the problems. I mean, in addition, even if you have the perfect education program, as long as you have brokers or originators who have strong financial incentives for offering more profitable products that offer riskier terms, even the best informed borrowers and perfect disclosure forms are not going to win the day in that calculation.
Well, I'll agree with you that there's a problem there too, because the FHA data were the first opportunity to really look hard at the differences in the terms on brokered loans versus loans that were originated through depositories, and there was a big difference. And how can economists on the one hand claim that incentives matter and not on the other anticipate that they're going to find this? You know, so that if you've got somebody who's basically on an eat what you kill model versus a loan officer who earns a salary and maybe a little bonus for volume, that there's going to be a difference in the terms borrowers get from those two entities? Of course there is.
I've got to remember the eat what you kill line. That's good. I'm going to use that.
Okay.
Hello, I would like to add to this conversation. It's surprising to me that it seems to be a general consensus that regulation of the financial industry is necessary, and nonetheless, most of our discussion has been about disclosure and putting the onus or the burden on the consumer to make more informed decisions. A lot of the literature and research coming out of the risk perception scholarly work, which is very large in areas of right to know, chemicals regulation, environmental regulation, clearly shows how difficult it is for individual people to make good decisions about risk and the risk that they want to face. If the investors themselves were not seeing the risk and making bad risk decisions, how reasonable is it to really be talking about disclosure? Shouldn't we be talking much more about the regulation that a number of people here today have said is necessary?
Well, let me say that the fact that we're talking about disclosure does not mean that's the only thing that ought to be talked about. I have a whole list of regulations, which I hope you'll read when you buy many copies of my forthcoming book, for almost every part of the financial market. For example, someone asked a question about derivatives. Should we have some kind of way to check out derivatives before they're put into, if you invent a new derivative, which you just thought up last night, before you sell 60 trillion of them, should you have somebody look at it and say, well, that's a good idea, or that's a bad idea, and shouldn't you register that with a central agency so that everyone will know what it is, and so that when you sell it, you have to register the sale? I think all those things are desirable. I think we're going to move into a much more pro-regulation climate in the next years than we have been, for the obvious reason that lack of regulation has not worked. And so I don't think that talking about disclosure is in any way a rejection of the idea that there ought to be more regulation.
Because you get the disclosures only with regulation. It has to be a regulator who leads to bring the disclosures into existence. The industries won't do them voluntarily.
Yes, sir, back there.
We've already had some disagreement about how well the GSEs have performed their mission. I'd just like to have the panel comment on the scope of that mission, and specifically their involvement in multifamily housing, rental housing. If you look at the first half of this year, there's a significant increase in Fannie and Freddie's activity in multifamily, in their lending activity in multifamily, at a time when there was concern about a shortage of availability of capital for single family. If you look at their lending in multifamily over the last couple of years, it's included things like providing $9 billion to two private equity funds to take Archstone Smith private. Is that part of the future of the GSEs?
A little bit about, there isn't a fixed pot of money that they have to hand out. Doing more multifamily doesn't mean doing less single family. But multifamily's always been a problem. It's always been a problem because it's a little bit like subprime. It's much harder to get information and to securitize it and to manage the risk. Both Fannie and Freddie in the 80s and Freddie in the late 80s and early 90s had a lot of defaults on multifamily property, and it's tough stuff to manage, which is why it's always been a small part of the business.
And the ugliest stories from FHA are all multifamily stories, too.
Yeah, multifamily is, you have to underwrite each of them individually. And certainly in the FHA context, and to a significant extent, but not exclusively in the Fannie Freddie context, they're big projects. 50 units, 75 units, about 90 units is the FHA average. That means they're important, at least politically, locally, they're important, and that means you have people weighing in on them. They're very staff intensive. When I was at FHA, 2/3 of our staff was in multifamily and 1/3 in single family, and the portfolio was 90% single family and 10% multifamily, and I did not feel that I had too many staff devoted to multifamily.
But multifamily is a very important part of the housing stock of the country. I mean, somebody, I guess it was the gentleman from Wells Fargo, sort of implied that everybody ought to be a homeowner in the United States. I think that's a big mistake. At least a large fraction of the population is not suitable to be a homeowner because they don't want to be a homeowner. They're about to die in the next 2 weeks, and they don't think this is not the time to buy a home, and or they're too poor to afford home ownership. We have had a of course, that's the only way I could beat you. No, we have had about 1/3 of our population living in multifamily housing for many, many years. Now it's gone down as a result of the big push on home ownership. I think the federal policy is way over biased towards home ownership against renters, and we ought to change the tax structure favoring home ownership so it doesn't all go to the wealthiest homeowners. There are all kinds of things that I don't agree with the federal policy that overstresses home ownership, and one of the consequences is trying to push people into homes that they couldn't afford. And the government and Congress were both involved, the federal government and Congress were both involved in sort of promoting the beginning of the subprime movement. And I think that was partly a result of their over-bias in favor of home ownership. The spending of money by the government is way over-biased for home ownership in terms of the tax benefits, et cetera. So I think home ownership is a great idea. I agree with you that it's better, a neighborhood of homeowners is better than one completely of renters in terms of maintenance of property, et cetera. But nevertheless, I think the present policy of the federal government is way too much biased in favor of home ownership. Yes,
okay. Thank you, Tony. I have a bias towards fractional ownership of homes, so I want to get that out front. But then I want to ask if the problem we're trying to solve is basically not solvable within the range of options that we have put on the table. And here's my point. If corporations could only fund themselves through bonds, there would be a big problem. The big problem is corporations are risky, and bonds will default, and nobody would want, to loan to corporations that had no substantial equity sliver. Now, for a long time, we thought homes were not risky assets. They were assets that went up 2% every year. Now we understand they are risky assets. So now maybe we have to understand that homes have to be financed more like corporations, and that there has to be equity, and that equity probably has to be significant. So that opens up the possibility of homeowners and renters to be a continuum. In other words, you don't have to own everything or nothing. That's not the usual situation. It just happens to be the situation in homes. The second benefit of doing something like this is that the biggest problem that we face here is the loan-to-value ratio. And that depends on the value of the home. And we have no idea what the value of these homes are. And in the equity market, the reason bonds can be priced reasonably in the corporate markets is they get the signals on the prices of the equity. So the bondholders know what the risk of default is. So we have no equity market in the home ownership, and that has two really big negatives. One is it keeps a lot of people out of homes because they can't afford 100% of one. And secondly, it makes the whole mortgage problem almost impossible because no one knows what the volatility of the underlying asset is.
Well, the mortgage problem is not impossible from the fact that a very large percentage of homeowners have mortgages. And so you can't certainly say that it's impossible. And I think that one of the great advantages that people think of when they're thinking of home ownership is that this home is mine. I own it, or my family owns it. The equity in it is mine. I control who comes in the door and who doesn't come in the door. I don't want to be a corporation. This is just my own personal opinion. I don't think dividing that equity up among you and 5 different corporations meets with the whole concept of home ownership, which is part of the so-called American dream.
Yeah. Well, that's fine. No one says one has to do this. It's an option. You don't want to do it, you don't have to do it. If someone else wants to do it, he could do it. That's the point.
Can I just a quick, what you're talking about is pretty close to shared appreciation mortgages, where someone else takes an equity interest in the property. And people have been talking about that for quite a long time, and it hasn't got off the ground. And I think a part of it is because there are real sort of agency problems with that one, and that's a problem. In terms of the risk, and maybe Chip should talk about this, there is a way of hedging local house prices. There is a futures market that isn't doing very well, but one way of handling this problem that you've got all of your equity tied up in this house is pushing markets like that. Unfortunately, it doesn't seem to be working very well.
I have one quick question, which is about, we've talked a lot about disclosure for homeowners, but the question is one of the problems we've had is that rating agencies screwed up really bad when they securitize these loans. And there's been a lot of talk about equity stakes in what you put out, et cetera, but isn't the fundamental problem that the rating agencies were able to call things AAA without any oversight whatsoever?
Yeah, I think that is a part of the problem. I'm not quite sure what to do about it, because I think a lot of both the investors and the sellers liked it. A lot of AAA investors are regulated to hold AAA, and I think to some extent they actually like the idea of new stuff being rated AAA because it has high yields and it expands what they could invest in. And I think, as I said before, I think one of the problems in this, because there was this new technology of securitizing and structuring this stuff, you needed a rating, and they got a rating. And it was easy to look up what it took to get a AAA rating. And the old parameters and old models that people estimated didn't have everything in it, so you could select against it. And I don't, there are people who have talked about rating agencies keeping a stake in what they do. And I think something like that's a good idea, and maybe it'll evolve that way.
Well, the rating agencies, the failure of rating agencies has changed the globalization nature of the capital flows. When people are in Indonesia buying something that's a security issued on American houses, they have no way to check up on whether these houses are any good or whether they should buy it or not. They have to rely on somebody else who's closer to the scene to tell them the facts. That's what the rating agencies did. But once you lose confidence in the rating agencies, you can't get it back, because no one will believe. That's one of the key ingredients of the present situation.
On that upbeat note, can I thank Tony and thank the panel for this enlightening discussion.